So good afternoon, ladies and gentlemen. My name is Rich Harvey, CEO of Property Buyer. We're very privileged today to have Dr. Andrew Wilson, Master Economist, and great commentator for many, many years and a good friend to share with us his thoughts today on the property market, where it's going. Just before we kick off, just a few sort of, overview things. We will be going through Andrew's presentation. I'm sure you're going to have lots of questions. So what I'd love you to do, we want to make this interactive. Please write your question during the presentation in the Q&A box. And we're going to have around 20, maybe 25 minutes of Q&A at the end of the session. I'm not going to be speaking much today. This is more about Andrew's presentation and just some really good debate between us, Andrew, about where we see the market going. And we really want to get to your questions. So look, hopefully we can get through all of those there. Also, just as a background on Property Buyer itself, a lot of you are our customers or clients already, and we really appreciate your support. But for those that don't know about us, here's a quick overview of, hang on, I don't know if I've shared the right screen here. Give me 1 second. I've got to share the right screen, Andrew. I often get this wrong. All right. There we go, that one there. Yep. Just some quick overview. So Property Buyer's been going to over 22 years. We are Australia's most awarded buyer's agent. Very proud of that fact. Last year, we almost won yet again the National Telstra Business Award. We're one of 9 finalists out of 24,500 businesses. We're also members of RBA, the Real Estate Buyers Agent Association, and also PIPA, the Professional Property Investment Professionals Association. So we're here to help you. If you're a home buyer, we can help you. If you're a property investor, love to help you. A commercial buyer, or even a developer looking to acquire a site, but we only work on the buy side. If you are looking to sell a property, we can provide what's called a vendor advocacy service as well, and help you to match someone on our database, or else refer you to a good local selling agent and protect you throughout that process as well. I'll come back later to how we help people, but Andrew, I'm going to let you share your screen and give us an insight into where you see the market going forward from here, please.
Yeah, thanks, Rich. Just get this up and running. I think we're there. Are we there?
That's it. That's the one. Perfect.
All right. So I'll start to rock and roll, and we'll talk about my favourite topic, which is the housing market. And let's get through this in a bit over half an hour, and we can leave plenty of time for questions. But we are at the end of the year. I can hear those bells ringing, and the fat guy's coming down the chimney anytime soon. In fact, I think it's just about 1 month to Christmas.
It's about 4.5 weeks we'll be there. That's the one.
Yeah. So the market's certainly winding down, and we see the usual signs of a wind down in the housing market at this time of the year, particularly from auction results. Listings do surge towards through November and into December, various reasons. So there's a seasonal effect, and that pushes downward or puts downward pressure on clearance rates. But it's been a very positive market for our auction, very positive year for our auction markets this year. In fact, through May and into June, we had boom time results in Melbourne and Sydney. But it was a catch-up market, given what was lost last year. And it really shouldn't have been a surprise, but it was to many that we had a strong year this year, because it was about those value opportunities that attracted buyers earlier this year, despite all those interest rate increases. So we'll look at the forecasts, which we already know are in the bag for this year. Maybe chat about where we think we're going to go next year, but it won't be a stronger year next year. It won't be a crash, but certainly prices growth won't be near the double-figure results that we're getting in most capitals this year. Can you believe that, Rich? Double-figure growth in house prices.
Even despite the rapid interest rate rises, it's really a figure of supply and demand, constriction in supply that's really driving it, right?
Yeah, and still value. I mean, interest rates started at zero. So, we've had 13 rises. It started from zero. We've got probably the strongest economy in our history at the moment. So everybody's got a job. Wages are rising now at the fastest rate in our history. Well, certainly in the ABS, the history of the ABS series. So, lots of offsets, still lots of savings that we had through COVID that, and we're still spending. Retail sales are still high, in fact, they're higher than where they were last year, which was a real spendathon with all that stimulus money being surging through the economy. So they're the reasons. But look, affordability barriers are now starting to slow the market down. Prices have increased, as I mentioned before, generally by around about 10% this year. higher interest rates, of course, and inflation, which is at its highest level in decades. And that's another problem for households trying to match price. All we have to do is look at petrol prices, Rich, to know just how inflation is affecting us. But look, it's been a catch-up year in most housing markets this year. So they've caught up. The question is, where do we go from here? And that's why we won't see a strong growth next year, because I think we will have some more interest rate increases. We'll talk about that shortly. But also, we've those value opportunities, those discounts that drove buyers this year are really no longer there, because we're back at near price peaks again. So I don't want to give it all away too early, but I probably have. But there's a nice preamble for you. My brand is My Housing Market. I act as an independent commentator on the housing market. I just provide my opinions independently of any particular motivation, other than just wanting to seek the truth, which tends to be a bit of a problem with housing market commentators generally, but I would say that, wouldn't I? But we are all about the current state and future prospects of housing markets. We do provide our own data. We have a very robust and resilient data resources. So we are completely independent in terms of not just our commentary, but also the background data that we use as well. So current state, future prospects, but current state is the most important part of that phrase, because we do try to understand what's happening now in the markets. A lot of the data that does come out is backward looking. So we don't want to know what's happened 3 or 6 months ago. We're looking to find out what's happening now. And we use a number of correlating measures. So it's not just about house prices. It's also about other measures of activity, so that our opinions are based on, a robust and resilient set, I've used that phrase again, of data points. So let's get going. I think if you're a talking head in any particular field, you need to at least have some formal qualifications. Well, I have those. And they are in the topic that we're discussing today, which of course is the housing market. So housing market economics. I also have higher level research degrees. So it means that I understand pure research in that sense, and I have qualifications in that. And I'm also a member of the Royal Institute of Chartered Surveyors, which means I do belong to a professional body, recognised professional body. And it means that my skill set is also in measurement. Of course, my measurement is the housing market and the broader economy. I've also had a lengthy career, formal career as a property economist. My last formal role was as chief economist for the Domain Group, but I've been working as an independent provider of insights into the housing market since I left Domain in 2017, which is now quite a while ago. But nonetheless, we move on. I also get my head on the box every now and again. So I do provide media commentary in various particular areas. I think that's perhaps a validation that my opinions are still worthwhile. And maybe I'm looked as a bit of a trusted voice in the housing market, because I don't usually lean towards those hysterical doom and gloom headlines to attract what is called clickbait, Rich.
You're definitely not you're not a perma bear or a perma pro property person. You just say it as it is, Andrew. And I think it's also our joint hairstyle that gets us on the TV, right? So.
Well, it's a positive, isn't it? We don't have to worry about hairbrushes or hairspray, right, anything like that. But look, going forward, I think it's important to at least have that independent voice, and not to be, seduced by the headlines of doom and gloom, which tends to be the de rigueur, or what is normal for housing market commentators, because we know the media love those sort of bits and pieces. But I think that it's important that you have an independent but a rational view. And look, I'm not an optimist. I'm not a pessimist. I'm a realist. And my realistic view of the market is based on data as well as experience. So that's what formal research qualifications, make you do. So enough about me. We want to talk about me. We want to talk about our housing markets, and there they are in all their glory. And home prices, they're still rising, Rich. Despite that we're heading towards Christmas, and despite all that prices growth that we had, and just about everywhere they've risen. So this has been just about an across the board revival in the housing market this year. So really nobody's missed out. Maybe Hobart, but Hobart tends to go across or in the opposite direction to everybody else. But we're starting to see some earlier signs now that the Hobart market is picking up again. So Home prices rising and rising almost everywhere. When I look at the housing market, I like to break it down into three principal drivers of demand and supply. Demand and supply, people, which of course we've got to live somewhere, Rich. So people, of course, is the essential element of supply of demand. And importantly, as we've seen through the COVID period, that means migration. Now, migration really pre-COVID wasn't a big deal for the housing market. You might think, well, how can that be? Well, it was because it was very consistent. We had the same levels of high migration year after year. So our industries and our markets had adjusted to that. But of course, along came COVID. We shut our borders, no more migration. And now, of course, we've opened our borders. So we've gone from zero to hero with surging migration now and all these people coming in to live in Australia.
I think just on that, Andrew, I think you mentioned consistency, and I think it used to be about 200 to 250,000 a year on average would come to our shores. We then went to zero during COVID. Yep. And we're now in the past literally 12 months had 450,000 because we've had like 2 years catch up in 1 year. And next year, there's going to be another 350 to 400 and the following year, 350. So I'm saying there's potentially 1 million people within 3 years hitting our shores.
And we're building fewer houses than we did 10 years ago.
Exactly.
And units. And it's not just permanent migrants. The big surge is also coming from students, the temporary visas, and from tourists also. So we've seen this massive turnaround with open borders from tourists, not just permanent residents, but also the temporary visas of students and tourists. And of course, they've got to live somewhere, Rich, and there's just really nowhere left to live in a sense because we've just underbuilt for the best part of a decade. So that's the demand equation. And it wasn't just the international borders that affected housing markets, Rich. It was our interstate borders during COVID because we had severe lockdowns in Sydney and particularly Melbourne. And that acted as a catalyst to draw a lot of people out of Sydney and Melbourne into southeast Queensland, particularly, which was viewed as a safe haven market for those trying to escape those lockdowns. And that meant very strong prices growth, particularly, in those southeast Queensland markets, Brisbane and the Gold Coast, and still pretty strong markets there as well. But that was another impact of COVID and migration, not just the international equation, but also the interstate equation. Now, we're not seeing the same levels of surging migrants out of those southern states into Queensland, but it certainly has pushed prices up because, given southeast Queensland was typically significantly more affordable than Melbourne and Sydney, it was obviously fertile ground for those coming out of Melbourne and Sydney to push up prices, and demand was very strong. So that's important. We'll look at some of the data more closely for migration. But of course, on the supply side, we have home building, and home building's been a real disaster, Rich, for the last 10 years. We've had a lot of roadblocks. We get local planning controls. It's very difficult to get building approvals up, particularly for high rise. Red tape, green tape. And recently, of course, we've had this terrible situation where house building costs have gone through the roof. At one stage, they were rising or increasing by over 20% a year, and that's been a significant driver of inflation as well. Because we had that, we'll talk about that previous policy of the previous government that created a lot of demand, and we didn't have the supply to match it. We didn't have the building materials. We didn't have the tradespeople, and that's pushed house prices through the roof, which are just showing some early signs of normalizing, but they've got a long way to go. So
Andrew, just on that, if I may ask a question around building costs. I mean, I'm doing a build myself, and the estimate on the budget's gone up 30% to what I estimated. But do you ever, a lot of people sitting on the sidelines waiting to build think, oh, I'll just wait 12 or 18 months for the building costs to come down? Do you ever actually see them coming down or just plateauing?
Well, we started to plateau at around about 11% annual growth a couple of months ago, Rich. We've actually had some better news with house building costs, and we run a house building cost index. Has fallen below 10% annual growth over September. Now, that's still a big rise, 10% per annum. And the problem is that it sort of becomes locked in. So, subcontractors, building suppliers, that's the expectation that, okay, well, we're going to put it up 10%. And it's inflationary expectations that are always a problem in a higher inflation environment, because people just say, okay, well, the normal rate of increase is 10%. And it does get locked in. So that latest data, which showed it just falling a little bit under 10%, is good news, but it needs to be a lot lower, because typically, Rich, as you'd know, building costs used to rise by around about 2 or 3% a year. And that's, made it a competitive industry, and it meant that there was, more surety in terms of builders with their product.
Yeah.
But
I mean, my view is it's not going to drop back. I think that the price growth, I mean, the cost of a shipping container went up to 22,000 a container during COVID. It's dropped back to like 2,500 now, but I don't believe that construction costs are going to decline in the next couple of years. If anything, the price growth will moderate. So it's kind of going to be a tricky thing for developers when they're building in feasibilities where they've got a 5 to 10% contingency on their costings.
Yeah, that's right. And it means that we're going to have to start looking at commercial style contracts with rise and fall, that you can't do a fixed term contract anymore.
Yeah.
And because of the uncertainty around building costs. And even if that the certainty returns, as I said, I think the certainty is going to be a lot higher in terms of where costs move every year than they ever used to be, which I said was around 2 to 3%. But now it's 10% now. And, I think that may get locked in. Let's hope it doesn't. But at the end of the day, the consumer has to pay for that. And builders can get caught out because they can't make a profit with those sort of, cost base, that 10% increase. So it's like supply not matching demand. We've got, does it get any worse? We've got burgeoning demand, and we've got falling supply, and all these, sort of constraints that are coming in to make it even harder. So, like, even if you get your planning approval and you're a builder, you might not be able to get the job out of the ground because you can't make money on it because it's costing you too much to build the thing, right? So it's a tough gig there. And of course, the glue that holds supply and demand together is the economy. And when we're talking the economy, particularly with the housing market, Rich, we talk about interest rates, and that certainly has been a big topic of conversation over the last few weekends, where we had our first few weeks where we had our first increase in interest rates since June. Look, I've been saying this for a while. I think the Reserve Bank went into pause mode way too early. I'll look at that in a bit more depth shortly. And it always had to increase rates because even comparing us to international economies, particularly the US, we were well below their official rates, and yet our inflation rate is higher. So unfortunately for mortgage holders out there, I think there's more interest rates to come, but it's really a catch-up, sort of policy, because we paused way too soon without the sort of evidence. But we'll have a look at that shortly, Rich. So let's have a look at the economy in a bit more depth than interest rates. Of course, interest rates are important because higher interest rates make it harder to buy a property with a mortgage with your fixed interest, with a fixed income. But it makes it easier to buy a house with a fixed income with a lower interest rate. But local markets determine, or the aspects of local markets determine the rate of growth, because interest rates, of course, are set nationally. So it is factors such as migration and home building levels and local economic performance that determine the rate of growth in local capital city markets. But the underlying trend certainly is driven by what's happening in the big picture of where interest rates are set. So let's have a quick look at the interest rate cycle. These are home loan rates. You can see there that sort of roller coaster ride that we went through various business cycles, starting with the boom in 2006-07. Interest rates were rising. Then we had mortgage rates as high as 9.5% back in 2007. GFC came along, global financial crisis. We had to stimulate the economy, so rates were cut sharply. Mortgage rates down to 5.8%. Australia actually got a lift out of the GFC from mining boom number 2, courtesy of China. Again, we had higher inflation. Interest rates rose to cope with that. Mortgage rates up at 7.8%. But we then joined the rest of the world trying to stimulate underperforming economies with lower interest rates. Down we went till we got to zero, basically. Although we had a couple of little blips there, which may be a bit of a reason why we've got such a problem with our rental markets, because we had a credit squeeze put there on investors, which was independent of the Reserve Bank. And I think that acted to, reduce significantly the number of investment properties we have out there. And of course, that means higher rents and very low vacancy rates. But of course, when we slashed our rates through COVID, our mortgage rate fell to 4.5%. Average mortgage rates 4.5%, as the official rate was at 0.1%. But since then, of course, inflation has raised its ugly head globally. Again, too much demand, not enough supply with all those roadblocks through COVID. And we had the highest inflation since the 70s. And so up went interest rates. And our mortgage rate now at average at 8.5%. Now, this is quarterly data, Rich. We'll look at the latest monthly data, but this is the quarterly data results. But let's have a look at house prices, how they've responded to changes in interest rates. We sort of know intuitively, as we discussed before, that higher rates mean lower prices, lower rates mean higher prices. But it's interesting that higher rates don't see the sort of decline in prices that we would expect. In fact, lower rates, we tend to get a stronger response with higher prices than we do with lower prices from higher rates, if you understand what I mean. And that's because when rates do rise, we do get a lot of pent-up demand being created, because buyers and sellers tend to sit on their hands. And once the grey clouds start to clear and rates fall, a lot of that pent-up demand is released and we get a significant surge in prices. And you can see that through the cycles there. A little bit of that occurred this year, with pent-up demand created last year being released into markets this year. And that's why we've had a good recovery phase. But I think it's interesting, Rich, when you look at the cycles there, and the top one, Sydney, then Melbourne, Brisbane, Adelaide and Perth, you can see that sort of roller coaster ride, which occurs when, rates increase. But you can see how the trends, and this is quarterly data up to the September quarter, how, as I mentioned before, how the trends are really quite modest and consistent and predictable. You can see how we fell away when interest rates increased last year. There was a lot of doom and gloom, but you can see that the markets really started to respond generally in September last year.
But according to the Wilson curve from your namesake, right, the rate of decline, if you look at that steep trajectory, say for Sydney there, where it got up to, whatever percent, it didn't drop back 15 to 20%, did it? Right? It dropped back a marginal amount. And now we're almost back to peak highs again. We're literally months away from hitting record peaks again if it continues.
Well, we're going to look at the latest data shortly, Rich, so we'll be able to confirm all that, but you're 100% right. You can see that's the point with those cycles. They move back to where their previous peaks were, and that's what we've seen there. And all those cycles are heading back this year to where they were at their post-COVID peak. Of course, we had a very strong period in 2022 as a result of 2021 as a result of COVID, the COVID stimulus. And so that's that catch-up mode. But I think it's interesting to see that we really had clear signs in the September quarter last year that the markets were starting to turn. And I was saying that at the time, that markets, even though they were still falling, the rate of decline was improving. And this was a clear sign that markets were on the up. And yet we had a raft of commentators through the end of last year and into this year predicting ridiculous falls in house prices. 10, 20% falls were predicted, 30% falls were predicted, which was just palpable nonsense. But we've heard it all before. And it's just really a lot of cheap headlines. But what concerned me was a number of those forecasts were coming from banks who you think would know a little bit better, given what their business is, about house price movements. And we'll look at the historical record towards the end of the presentation, Rich, and that shows you that there's just no historical basis for the sort of nonsense that was predicted for housing markets. But it's a cheap headline because, media are all over that, predictions of significant house price falls. So moving on, you can see there that those cycles are just starting to ease again. Sydney just easing after a very strong June quarter, September quarter just easing. We'll look at the latest October house prices shortly, and we'll just see where our housing markets are right now. But you can see that's really a consistent movement upwards from most of those capital city markets. So again, it just validates, how reliable and resilient our housing markets are, even in the face of 12 interest rate increases that we had from May last year to June this year. And of course, we've now got another one in the bank, unfortunately. And as I said, I think perhaps more to come. So the RBA has conceded. They conceded that in a sense that they went too early. They paused in May, they rose in June, and then they paused every month up until November. And of course, on Melbourne Cup Day, they predictably, in my opinion, decided to raise rates again. When we look at the latest minutes from the RBA, Rich, which were released just a week ago, there's full of, the phrase this then expected is just a real mea culpa in terms of how they got it wrong in so many ways on their forecasts. And it's interesting also in those minutes that they're mentioning now a lot of the data being sourced from staff. So it's like they're saying, oh, well, staff said this and staff said that. It's like, hello, is this the blame game? Or shifting responsibility. But at the end of the day, I did say quite clearly that we paused too early. And the clear indication of that was the fact that in the US, currently the US official interest rate is more than 1% higher than ours. And yet their inflation rate, Rich, is 1% lower. So even on that comparison, and the Reserve Bank conceded that in their minutes that it was different. So in a way, we just went too early. There was no real substance to other than just, thought bubbles, I think, from the Reserve Bank to justify going into pause mode. And what worries me is when you take the foot off the brake and the car's still screaming along at 200 Ks, you just got to slam it on again, and we'll look at that latest economic data shortly just to sort of see whether we have any sign that the brakes have worked to this point again. So rates up again. The RBA conceded that rates were still too low, followed those 5 pauses over the last 6 months. The economy is still clearly strong, but despite those 12 rate rises. The jobless rate is still down near record lows. Jobs are surging. Unemployment generally has been falling. The participation rate is near a record high. Retail sales are still rising, remain significantly above pre-COVID levels. Despite the migration surge and inflation is now rising consistently again, particularly housing, food and fuel. So as I said, I believe the Reserve Bank got it wrong by pausing too soon. This is this track of official rates, Rich. Up we go. We sort of had a pause. That pause probably is the end of that cycle, if we could call it a cycle, because it was paused long enough. And now I think we're back into a raising cycle. But look, we're still below where we were at the peak back in March 2011. So we really haven't got back to where we were at the previous increasing cycle back in 2011-12. Inflation is up, as I mentioned. Annual inflation up from 5.2 to 5.6% over the month. The previous month, it was up from 4.9 to 5.2%. So this is what it really motivated the Reserve Bank to act. 2 months in a row of higher headline inflation. Underlying inflation, which takes out the volatile items such as fuel and food, was steady at 5.5%, which is way too high, which is the target's 2 to 3%, Rich. And yet we're at 5.5%. And as I mentioned, it's the best part of 2 percentage points lower than the US, who have 1% higher interest rates. So again,
I think one of the factors that's been the reason for this, Andrew, is why inflation hasn't been tamed so quickly is people's expectations were that rates are going to stay where they were and their buffers were up, so they'll just keep spending as they were. But the buffers are coming down rapidly now, and I think we're going to have a what I call a thrifty Christmas. People are going to be a bit more thrifty about how much they spend on everything. Everyone's complaining about tolls and fuel and rents. So I think it's really these possibly one more rate rise is really going to bite people's hip pocket nerve.
Well, we've still got a very strong economy out there, Rich, and we'll look at that data in a minute. And of course, we have Black Friday tomorrow. So we will test that theory of yours to see if the spending...
Everybody loves a bargain on Black Friday, though. You watch, the numbers will be up still.
Well, we'll see what happens, mate. So as I mentioned, the inflation target's still well ahead, or the inflation rate is still well ahead of the target of 2 to 3%. And one of the mea culpas in the latest minutes was that they now reckon that's going to take longer to get back to the target. And of course, this is the reason why, we had that rate rise, and we're likely to get, I reckon, one in December as well, but we'll wait and see on that. So the labour market remains remarkably strong despite higher rates. October jobless just ticked up a little bit to 3.7%. But that's, ridiculously low. We have to go back to the early 70s to see these sort of numbers. More strong increases in jobs, up by 55,000 over the month. Of course, migration's part of that, driving higher numbers of jobs. Unemployed was up, number of unemployed after a few months of falling unemployed. We actually got a counter to that, up by 28,000. That's what made the unemployment rate rise. And the participation rate, which measures the proportion of the number of people in the workforce who could potentially be in the workforce. So that's at a record high 67%. So we're still dragging people in.
They're incredible numbers, Andrew. I mean, I remember when I studied economics, 5% unemployment was considered full employment, and a participation rate of 60% was considered really good. And we're smashing those.
It's I believe the strongest economy we've had in our history, Rich.
Yeah.
Certainly with this sort of data to justify it. And all the states are recording low unemployment rates, with the New South Wales the lowest at 3.4%. You can see the unemployment rate. Now, what's remarkable about this is look how flat that unemployment rate is. We really haven't seen. We have to go back to much different times, economic times, to see such a flat cycle for unemployment. It's the best part of a year. We've just been around 3.5%, month after month after month, and it's just shows you how strong and resilient this economy has been. I think, we've really got to get into the fours at least before we start to see an impact on inflation, but the future will reveal that. Now, the other point that we had, recent data, was the National Wage Index. That comes out every 3 months, Rich. We had the September. It's a bit backward looking, but it was eminently predictable, really, because we had a bit of a shock result over the June quarter, because we actually saw the rate of annual growth lower than the previous March quarter, which was crazy given how strong our economy had been. But all bets are off now, because we went back to what we expected to see. And there has been some issues with ABS data lately, but I won't go into that. But we've recorded the highest rate of wages increase over a year ever in this series. So up by 4%. That's the highest rate of increase the ABS has ever recorded for the wage increase. So up by 4%. It's not good news for the inflation outlook. The Reserve Bank would be looking for lower wages. In fact, in their recent minutes, they were saying, we believe that wages growth isn't accelerating. Well, they got that one wrong again, because wages growth is accelerating. Look at that, 1.3% over the actual quarter. If you measure that by 4, that's over 5% annualized growth. So the problem with that is that, as wages rise, employers have to figure out a way to cover the higher wages. And if they're not getting productivity gains, which they're not at the moment, they have to put up their prices, Rich, which will only act as incentives for people to need to have that 4% plus wage rise, And the reason we haven't probably seen this as much as other, economies such as the US is because we have such a sticky wage setting environment. Our wages typically reflect those annual or even 2 yearly wage reviews. You've got to wait that time to get your rate increase. So it's not good for interest rate outlook. That will concern the Reserve Bank, because accelerating wages are a factor in rising inflation. You can see there the surge in wages that we've had just over the last period. That was a bit of an unusual dip that we had in annual growth over that June quarter. But now we're higher than where we were back in 2010. So, at least it's helping, cater with inflation. But Rich, here's the bad news, mate. Underlying inflation is running at 5.5%. That's underlying inflation. And yet wages are only growing at 4%. So you're actually going backwards at 1.5%. So that comes to what you were saying about this. These are tough times. If you're going backwards at 1.5% a year, that can't be sustained, obviously. And that's why we'll likely start to see some issues with, it's going to put upward pressure on wages to cover that shortfall, So not good, that loss in real wages, falling real wages. Retail sales, I mentioned that they were up again, up by 0.9%. That's the highest rise since September last year. They're continuing to rise, not at the same rate as they were last year, but hello, we had COVID stimulus last year. Let's not try to make something out of nothing here. And we've seen the ABS particularly saying, the trend is falling to record low levels. Well, yeah, because it's coming from a record high level. We're still, spending at the COVID rate, which is unbelievable. Retail sales, as you can see there, how they rose through COVID, they're still 30% higher than pre-COVID levels. So we're spending 30% more at the moment than we were during COVID, which is a huge increase. And even accounting for inflation, even accounting for migration, we're still spending very, very strongly. So there's no good news here, comparing it to last year, because last year was crazy in terms of what we were spending. But it was all that stimulus money, Rich, that was moving through the economy. Price of oil, some better news there. You'll probably start to see lower oil prices at the bows are now finally starting to fall. You know, a lot of the prices, capital city petrol prices were over $2, heading towards $2.50 a litre. But that should come down now. And the trend looks pretty good there, despite what's happening in the Middle East. The price of oil is certainly easing, and that's a significant factor in inflation, of course. So let's keep our fingers crossed that continues. So let's have a quick look at some of those key drivers. As you mentioned, Rich, there was planned on 200,000 to enter Australia. It's more like 500,000. Where do they live? That's the problem. Overseas migration is booming since the surge. You can see that complete reversal from lockdown in terms, this is net annual migration. So this is the total number of people coming into Australia versus leaving Australia. Look at those numbers, massive numbers from, you know, zero. And Queensland's the only state that sort of kept its head above water during COVID, and that was because of those interstate migrants coming out of lockdown capitals, Melbourne and Sydney. Let's have a look at supply, home building. We mentioned how home building approvals have been significantly lower. No good news there. The latest data over September, building approvals down 4.6%, which followed a fall of 7% over August. Units were down 5.1%. Houses down 4.6%. Queensland, however, bucking the trend there, up sharply by 34.6%. And certainly annual growth levels remain chronically depressed. This is the quarterly trend for national home building approvals. You can see down and down and down since that stimulus package of 2021. And when we look at the data, the monthly data, everybody down, houses, units, and the total over the month. The year to date down significantly, and the full year also down significantly. So just no signs of a revival in home building, which we desperately need, Rich, as you know.
Absolutely.
And when we look at the underlying trend of capital city dwelling approvals, so this is capital cities, and this is the annual trend on the monthly data. You can see that we're actually significantly down on the peak, which was back in 2015-16. We're building we're approving 36.5% fewer than we built way back there, you know, nearly a decade ago. And when we break that down, we can see that it's units that have really suffered the big fall. Units are down 52.3% since 2016. We had that big surge through the home builder package from the previous government in 2020 and 2021, but we're now tracking below previous peaks to that. So that was good, but it didn't last. And you know, now unfortunately, what it did was create high house building costs, which has meant, you know, unfortunately.
So Andrew, if building approvals are down 36%, and our government, whatever persuasion, wants to build 1.2 million homes in the next 5 years, which is 240,000 dwellings actually built.
Yeah.
You're telling me if you go back one slide, we're actually only building about 160. So we're significantly short. And I think the other point to make about these slides is that these are just approval numbers. These aren't actually built properties.
Yes.
What percentage would you estimate are kind of left on, like once you've got a DA in place, what percentage actually don't get built in that year? Is it 20%?
Well, look, whatever it is, it's going to be lower now because of higher building costs. That's the joker in the pack, that whatever it is, Rich, it's worse now than what it was because of higher house building costs, you know, because builders are struggling to make a profit with these high house building costs. So as you said, even if they get an approval, there's no guarantee that's going to get out of the ground, because they've got to make, you know, they can't start building unless they've got a profit there, you know.
So I guess the key point I'm just trying to make here is, what's the message for both the home buyers, the investors and commercial buyers watching this webinar? And I think one of the key messages that I sort of wanted to drill home is that if people sit on the fence, think about buying a property later rather than sooner, it's not going to get any easier 12, 6 months or 3 years down the track. If you can get a property now in your portfolio, you can ride the capital growth wave. You ride out the inflation, like the wave of inflation, whether it's 2% or 5%, doesn't matter, because property is a great hedge against inflation. And I guess it also gives me confidence to invest, knowing that I'm not investing in an oversupplied market. I'm
Yes.
investing in a severely undersupplied market. And
Yeah.
I think the trick for investors is to find the individual suburbs and localities which have a chronic shortage where it's more likely to accelerate above the average as well.
Yeah, look, we've run out of housing, Rich, and this isn't something there's a short-term fix for. This is a chronic undersupply of housing, which is systemic. So it's the system that's broken here, and we can't fix the system. We can't change local planning rules, right? Because that's set in the Constitution. The Constitution says that land planning is in the hands of the states, right? And we'd have to have a referendum to change that, to get, a big picture policy from the national government. Now, the national government's just doing all they can, but they can't do anything because they can't build them themselves. We're seeing more public housing being built, but it's just, tiny amounts compared to what we need. We need hundreds and hundreds and hundreds of thousands of new homes, and they will only be built by the private sector. Rent to build is another. Yeah, okay, we're going to get about 20,000, maybe 30,000 properties in rent to build. But it's just a tip of the iceberg of what we need, right? And look, the governments are doing all they can, but they're constrained. They don't build the houses. The private sector build the houses, and they're trying to make it as easy as possible for the private sector. But it's still got all those issues of red tape and green tape, and of course the planning constraints.
That's right.
So as I said, there's nothing they can really do about that. And we've got, this remarkable surging, migration, and that's not going to stop. So it's you're 100% right. We've run out of so it's like housing's becoming as rare as hen's teeth. You know what I'm saying? That's the point. And this imbalance between supply and demand is not going away anytime soon, because we can't fix it. We really can't fix it. Certainly on the supply side anytime soon, and that's really in the foreseeable future. And I don't want to be really negative about this, but it's like, well, ever, and it's just going to mean owning a home as an investor or an owner occupied has to become even more of an aspirational target, because we've basically run out of them. And you got to live somewhere, mate. You got to put a roof over you. And what'll happen, is we're going to see people staying with their parents longer.
Well, this is the thing. There's lots of people put analysis out saying, oh, well, there's excess rooms in all these houses around Australia, but nobody's going to rent out individual. I mean, there might be some people rent out individual rooms, but as a widespread policy, it's not going to solve the housing crisis.
No, it's just, it's a theoretical thought bubble, which, okay, it's logical, makes sense, and we can do it. But you really think that's going to create hundreds of thousands of dwelling opportunities?
No,
really. Well, it doesn't. But it's, like I said, it's just unfortunate that there's really no answer to this problem going forward. Yeah. But it does, as you said, it represents opportunities for those.
So apart from building approvals, what other numbers have you got for us, Andrew?
So let's have a look at the latest housing market insights as we're starting to wrap up. Rents, of course, are still very tight, rental markets. The latest data for October, it's still tough results for tenants. Low vacancy rates remain, and rents are still rising, particularly for houses. We're not going to fix it. Again, this is the big picture, the undersupply. It's been exacerbated by years of really poor thought out policies against investors, which restrained and were disincentives for investors. In fact, I think it's interesting that governments are now talking about, hang on to your hat here, Rich, they're talking about incentives for investors, for private sector investors. Well, you're like a decade too late now. And this is the problem with all those ideologies that have infected policy making. And now reality is bitten that, hey, we have 40% of our housing is provided by private sector landlords, and we've been knocking them from pillar to post, for decades. And now it's like, oh, maybe there's the solution. We need more private sector landlords. And finally, they're woken up. And this is the tension that eventually you create when you have a private sector environment, such as we have in housing, and you start having those sort of left of centre type policies that are designed to control the market. It just ends in, a disaster. And that's what we've got for tenants at the moment. We don't have any sign of relief for tenants. Vacancy rates are at ridiculously low levels, and rents are continuing to rise. So, and of course, higher interest rates, Rich, what are the landlords going to do? Yep. They're going to pass on their costs, and they can do it because there are queues and queues of tenants on every vacant property just about advertised at the moment. So this is the latest data. Sydney still leads the pack with rent, $750 a week for houses, steady over the month. But look at that increase of 15.4% Sydney rents over the year. Melbourne up 16%, Brisbane up 11%, Adelaide up 12%, Perth up 13%. This is the annual increase in rents for houses, Rich. And look at Sydney, they're still the best part of $200 higher than the Melbourne median rent. So if you're in Melbourne, gee whiz, and it's tough, think about what you've got to pay for a similar property in Sydney for rent.
Yep.
Look at these vacancy rates. These
Now,
are nuts.
in all my career, I've never seen the vacancy rate so low. I mean, 2% used to be considered normal,
2% was sort of a balanced market, and
Sure.
you'd still see rent rises, but this is just silly.
Crazy.
When we've only got one market there, two with Canberra, that has got a 1 in front of it, and they're just got a 1 in front of it.
Yeah.
All the rest are basically saying, "No, we don't have any houses for rent." So it's a really tough thing now. Units in Sydney, same price as a house, medium rent for a unit, 750, steady again. But look at the increases over the past year in unit rents. Of course,
huge.
Coming from a low base through COVID, so that was always going to be a big tick up, but 30% up in Sydney, 23% up in Melbourne, Brisbane up 20%. So again, these vacancy rates just about a little easier than the houses, but still very, very low vacancy rates. And as you said, we really don't have a historical precedent for these low vacancy rates. And it's not just it's the consistency across the board in just about every capital. Only really Hobart and Canberra, or Hobart is an underperformer, and it has a very small unit rental market anyway. So we can't read too much into that. So let's have a look at house prices. This is the latest house price data for October, which was a little bit of a surprise, Rich, because we've seen a revival over the later part of spring in house prices, which were starting to ease predictably, as we've mentioned, those issues with affordability. Catch-up market has caught up, but we're still seeing a bit of a late surge in house prices over the October quarter. So this is comparing the October quarter with the September quarter, which is quite a robust data set. So we're getting 3 months worth of data, but we're comparing it to the previous 3 months of data for the last month. So it's quite a robust set. And most capitals are still recording solid to strong growth in house prices this year so far. And unit prices are also rising sharply. So this is the national house price. You can see how that's consistently grown through the year. Remarkable result, of course. It's a weighted average, Rich, which means it covers basically the big capitals in terms of weightings. But you can see how markets revived from January all the way through and continuing to rise over 8 consecutive quarters. This is the data. Sydney up 0.9%, which was a nice bounce back in Sydney over that October quarter. It was its strongest result for a couple of months. Melbourne up 0.3%. Melbourne's probably been the underperformer this year, Rich, as we'll look at the data shortly. Brisbane up 1.2%. Strong result there in Brisbane. And Adelaide up 2%. And Perth, which has been the big performer this year, that Perth market up 2.3%. But let's have a look at the year so far. Sydney up 9.5% to October. Melbourne up 3.4%, but Brisbane up 8%. Adelaide up 9%, and Perth up 11.1%. Rich, so some strong results for house prices. And let's not forget all those predictions that were made of house price crashes for this year. And this is the result. You got to be happy with these numbers.
Absolutely.
And as you mentioned, when we look at the previous peak, Sydney's just 1.3% now below its previous peak price, which was recorded in March last year. I'll give you a little tip. Sydney, with the latest November data, Sydney's now exceeding its record high price. So it's actually caught up. Melbourne, as I said, has been a little bit of the underperformer. It's still down by 3% compared to the same.
Any particular reason for that, Andrew? Do you think
it's very? I get this question a lot, Rich. But Melbourne has been an underperformer to expectations. I mean, it's still growing, but it hasn't grown to expectations. But we've got to remember that the Melbourne economy is really struggling at the moment. Melbourne has the highest, on a number of measures, it has the highest tax per head of population of all the capitals. It also has its debt is higher than Brisbane. Its state debt, as Victoria, is higher than New South Wales, South Australia, and Queensland all put together. So, I mean, I'm not saying that there's a direct correlation, but, the Melbourne economy has struggled compared to others. Whether it's that or there's still a little bit of doom and gloom hangover from what went through COVID.
I think particularly the land tax changes that's there has shied some investors away.
Yes.
But I think if you look at the long-term projection for Melbourne, it's actually very attractive. If we look at, the historical over 20-year period, Melbourne's actually tracked pretty similar. I did analysis the other day looking at property prices in the next 20 to 25 years. And, my belief is again, Melbourne has actually just overtaken Sydney in terms of total volume of population due to a statistical change. And it also gets a very strong share of migrants. So I think it's got a very strong future. And given its slight underperformance, I think it's actually primed for growth over the next three years.
Yeah, well, that's what I've been saying, Rich. I thought Melbourne was primed for a good result this year. It's had a positive result, but it's still 3.4% below its previous peak, which again was in March last year. So there's value opportunities there for buyers in the Melbourne market. That's the point. You're still getting a 3.4% discount generally on property. So I think there are good opportunities there, but I just think there's that little lack of confidence, that little lack of spark in the Melbourne market. But at the end of the day, you've got to live somewhere. As you mentioned, demand will overtake supply. It is they build more houses and units in Melbourne than anywhere else, and they are getting more migrants than anywhere else. Well, they eventually will get the high levels of migrants. So eventually that supply-demand equation will work to increase activity. And I think that the discount that's available there is also a special in terms of driving demand going forward. So national unit prices, they were steady over September, but they've bounced back quite strongly over October. Melbourne up 1.2%. The year so far, 6% rise in, I'll just go back, too quick on the button. Up by 6%. Melbourne up 1.2% over the month. This year, just 2.1%. Brisbane so far up 9.2% for unit prices. Strong result there for Brisbane, and Adelaide up 12.6% for unit prices. A smaller unit market, Adelaide, of course. But I think the interesting one there is Brisbane up 9.2% because that has a big unit market now in Brisbane. So let's have a look at our forecasts. These are the forecasts for this year. And we already sort of know that with what we've just seen there. But before we do that, I want to have a look or take a look at the historical evidence that I spoke about for house price changes, Rich. So if you're going to make a forecast on anything, please at least look at the historical data before you start talking about these outrageous 20, 30, 40% annual falls. This is official data going back all the way to 1987, Rich, and this measures the change in house prices from the December quarter to the December quarter. So no fiddling with the numbers here. It's just a straightforward December quarter to December quarter change in the median house price. And you can see there since 1967, Rich, Australia, this is the national house price, right? Sorry, national annual capital city. So it's the weighted average of the capitals. And of course, that skews towards the big capitals, Melbourne, Sydney, Brisbane. But nonetheless, we've only had 4 years out of nearly 40 years of house price falls. So if you reckon you're a big bank or whoever's doing a bit of forecasting, have a look at the historical. That's where you should start. Yep. Have a look at the historical record before you start talking 20, 30, 40% falls, because you just end up looking like a bit of a dill, if you're doing that. There's the record, Rich. The worst we've ever had was 5.5%, which was in 2018. Last year, with all those interest rate increases, we only fell by 4.3%. And so far this year, we're up by 7%. So we've already caught up on what we lost last year. And look at all the black lines there. That's all the above the line stuff. Yep. And look at 2021. I nearly didn't have enough room on the chart to fit 2021 in. It's just gone through the roof. So like I said, let's at least have a bit of common sense when we're doing house price forecasts. And isn't that where you start with the historical evidence for the first point? The worst we've ever had was 5.5% in 2018. And we're up nearly 7% this year so far. And of course, the predictions were 20, 30%. Whatever.
It's interesting, your chart there, because it's very similar to one that I just did the other day for all the capital cities. I look back the last 25 years to estimate the average annual change in house growth. And basically, it's about 7.5% for Sydney, 7.6% for Melbourne, and Brisbane's about the same. So it's very close to your 7% number there.
Well, we've got up there, the 36-year average is 6.8. That's the 36-year average in this data series is 6.8. So that's exactly what you were saying.
Yeah.
So this is my barometer for change. We're already sort of there. We've seen those numbers as they are with the latest October quarter data. Sydney, Perth, around about 12%. Maybe not get to 12 Sydney, but they'll certainly get to 10, I think. Brisbane, Adelaide up around 10. Melbourne, the underperformer, around about 5%. These are mid-range forecasts. As I said, they're pretty easy to do because we're already nearly at the end of the year, and this is for 2023. Canberra, Darwin, 3%. Hobart, flat. Unit prices, Adelaide up 12%. Brisbane, Perth, 10. Sydney up 8. Melbourne, 4. Canberra, 2. So let's just talk about next year quickly, Rich. I think next year generally is a 3 to 5% market. So the better markets will be around about 5%. I think that's Perth, Adelaide, and Brisbane. I think Sydney will do around about a 3% next year. And I think that's almost a conservative estimate. And Melbourne around about 3% as well. And these are for houses. So obviously not the 10% this year. As I said, 3 to 5% markets next year, depending on local factors. But I think the top end of the range there will be Brisbane, Adelaide, and Perth. Middle range, Sydney and Melbourne, and the smaller capital markets, the capital city markets, will be the underperformers. So we'll see how we go. We're recording this, so you can hit me around the head in a year's time. But we're pretty close to my forecast a year ago for this year.
We'll see how either conservative or optimistic you've been in the face of higher interest rates. But interesting, yeah.
Yeah. But the point is that we're still, even with that 3 to 5%, that's covering what we would see as inflation anyway, and that'll be what wages rise by. So people will bid that up just based on their extra income. So I don't think that's outrageous. And I think with interest rates, the Reserve Bank has shown they're going to tread carefully anyway. The point is that we've got our wages growing at the fastest rate in history. So, there is capacity, and that will continue with this very strong jobs market going forward. So let's have a look at the latest data to finish off, Rich, which is the data from the weekend's auction markets. As I mentioned, we typically see a surge in listings at the end of the year as the spring selling season runs out of puff. And that, of course, puts downward pressure on clearance rates. We saw that last weekend with a real jump in listings. Well, certainly a rise in listings and just a slight weakening in clearance rates. So let's have a look at the markets just quickly. Sydney, big number of auctions there in Sydney, 875 auctions. Sydney's tracked really for the last month around year high highs, if you know what I mean, year highs in auction numbers. And yet it's really the first time it's fallen below 70% in quite a while. So it's still holding up despite a surge in listings. Of course, what the higher listings do is it provides more choices for buyers and more competition for sellers. So it's actually a good time to be in the market in a sense, because you can certainly negotiate, I think, from more of a position of strength as a buyer, because the market is more competitive, So with all those listings, Melbourne, 1,160 auctions. Wow, that's a big number, well ahead of the previous weekend. But look, clearance rates sort of held their own in Melbourne in the mid-60s. Brisbane has a more of an unusual type of culture for auctions. So even though it had a 55.6% clearance rate, doesn't necessarily equate to what that would be in Melbourne and Sydney, which is certainly a buyer's market. Adelaide, big numbers. Adelaide's been tracking around 80% clearance rates for most of the year. Very strong auction market, Adelaide, but it's also just tracked down a little bit in the face of higher listing numbers. We see this every year through the late spring, Rich, every year, regardless of the cycle. We see lower clearance rates through November and into December. And Canberra's been a bit of an underperformer in terms of auction activity. You can see there the trends. Look how high that Sydney market was way back in May and June, nearly 80% clearance rates over the month. Big number there, Rich. So it's been a strong year for Sydney sellers particularly, but just starting to ease off typically. Same Melbourne. Melbourne had some strong results in May, also pushing up towards 80% clearance rates. But easing as the others are all doing the same. Brisbane, once again, strong late autumn, early winter markets, but just easing off. And Adelaide just tracking under that 80% result, which it's had for most of the year. And Canberra's been a little bit soft in the market this year, a bit of an underperformer. And its clearance rates reflect that underperformance. If you want those auction clearance rates, they're available every Saturday night on my LinkedIn account at around about 6:30. I get the snapshot of the capital city results, and Sunday mornings on LinkedIn, you'll get the full national report, including regional breakdowns in Melbourne and Sydney. So let's finish off now, Rich, by a summary of what we've looked at today. So inflation outlook is certainly darkening. We've had 2 months in a row of increasing inflation, and interest rates are now set to resume an upward trajectory. Let's hope that we can get some better news on inflation so that trajectory is not too high. But I would be looking out for an interest rate increase in December, which I think is still on the cards. And that's only because Reserve Bank has had a bit of a snooze-a-thon, if I can use that, through the middle of the year in terms of rate setting. But nonetheless, our booming national economy is well positioned to absorb higher rates. Remarkable data, incredible labour market, Rich. You know, people just seem to, oh yeah, whatever. This is a remarkable labour market. And now we're seeing the results of that. And that is wages growth accelerating, you know, to the record levels. And that's what we would expect with such a strong labour market. So that's well positioned to absorb higher rates when they come. House prices have continued to increase through spring, with growth rates actually accelerating, which was quite interesting given we thought we were seeing early signs of affordability constraints affecting outcomes. No doubt that rising interest rates constrain prices growth, and they do impact confidence in the shorter term. But as we've seen this year, underlying demand remains above supply, which does reflect that recent chronic underbuilding and the resumption of high migration. Housing market rebounded strongly this year, despite all those predictions of sharp falls. And the latest auction results reveal a seasonal easing of clearance rates from the typical surge in end-of-year listings. House prices will finish significantly higher over 2023. Most capitals up around 10%. If I could add to that, I think next year will be a 3 to 5% market going forward. And I think the outlook is for a much more reliable and predictable housing market, but a lot will depend on, because we're caught up with what we lost last year. So I think that's a good thing if we get that predictability, but a lot will depend on what happens with interest rates going forward. Rich, and
fantastic.
Fingers crossed that sort of works. So there's our last slide. Demand ahead of supply, confidence restored. Prices are still growing strongly in 2023. So that's all from me, mate. And I look forward to some questions.
Awesome. Well, Andrew, that is just fantastic. I really appreciate that. I'll just jump out of that screen. We do have some questions. I'm not going to do my presentation. I'm just going to send it as a bunch of slides. I've got some examples of properties that we've recently transacted for a number of clients in both the residential and commercial space. Except to say that, as I said, we do both resi and commercial as buyers agents. And I guess, Andrew, what you're able to provide is this brilliant sort of overview on the macro market and the capital city market. What we bring to the table is what's actually happening on the ground at individual auctions, at individual inspections, and we get to sort of provide a real insight into the market and really give our clients a competitive edge. Just a couple of comments I'd make just to reinforce what your view of the market is, Andrew. All of my presentations are quite similar to yours in the sense that we're looking at the key supply demand drivers, and I believe to 100% we are in a structural deficit for property for the next 5 to 10 years at least. I reckon a decade at least, unless we get a coordinated policy environment to improve planning outcomes, which are very, very difficult to change at a state and localised level. So I think what that means then, I mean, the title of our webinar is how do you navigate the next 2 years? How do you navigate these high interest rates? What approach, what strategy should you take? And for me, as I said, I'm an active investor. I'm looking to buy more properties and add them to my portfolio. I'm trying to get my kids into buying property at the moment, save for a deposit and get them into the market. Because if you sit on the sidelines and sort of wait for this market to crash, it's not going to crash. I was sitting on a plane coming home from Melbourne the other day, and this guy asked me, "What do you do?" And he goes, "Oh, wow, the market's just going to be crap itself." Like, and I couldn't engage in this conversation. We had absolutely diametrically opposed views. It was quite funny. But he was just going, oh, the systems, I won't use the word, stuff. But and some people just have a particular view of the market. But the facts and figures, if you've outlined, Andrew, are pretty salient and pretty obvious, is that if you're an investor in property, you've got a very safe market to invest to. You could still buy the wrong property, don't get me wrong. You could still buy the wrong kind of property in an area that's going to be rezoned for potentially a flood of properties that won't grow above the average. What you want to do is pick the right location and the right property within that location that's going to outperform the averages. I'm not going to go on, but let's jump into some questions, Andrew. So firstly, from Tony, says, Michelle Bullock at the RBA announced that interest rates will be increasing for the next 2 years to control inflation. What's the impact on the property market if the country goes into recession? Let me answer this one first, then I'll get your thoughts. I don't think personally that we will go into recession unless we get interest rates at 6%. I personally think there's maybe one, possibly two more rate rises. I think this last rate rise has really started to hurt consumers. I don't think we're going to go into recession. I'm an optimist. I'm just saying I don't believe we will. But I do believe the impact on the property market will not be that bad. It's going to be difficult for borrowers that don't have serviceability, but there are plenty of people out there with good jobs that can still afford to buy property. I think what's going to happen overall is you're going to have those that can afford to buy property and those that can't afford to buy property, and that gap is going to widen, unfortunately. I think we've got around 30% of people that own their own home outright, 33% that rent, and 33% are paying off a mortgage. And I think there's going to be an increasing proportion of renters over the next couple of years. Andrew, what are your thoughts on that question?
Well, we always seem to get that R word, don't we? Recession. It's like the big boogie word. But I'll tell you what, Rich, we couldn't be further away from a recession in terms of our economy's performance than we are at the moment. We couldn't be further away. We have a 3.5% unemployment rate, record participation rate. Wages are growing at the fastest rate in history, and yet we still have, that word being bandied about. Now, a recession is a construct. It's a measure of economic activity that's not part of what you might say the real economy in terms of, regular measurements, which is, things like wages and unemployment, But we would have to say, at least 6% unemployment rate, Rich, which is double what we've got now.
Yeah.
Remember, our unemployment rate was 11% when we went into recession in 1990-91.
Yeah, right.
11%. In Victoria, it was 13%. So they're the sort of numbers that drove a recession.
And we don't have the preconditions to hit those sort of numbers anytime soon. We are desperate for workers, so there's no way.
It would take some sort of international cataclysmic event for that to occur. Now, we've seen, outside events, the GFC, we saw COVID. These things can happen. But even through that, we were able to survive and thrive, in a sense. So the point is that, there is nothing to fear from fear itself, right? Everything I say today is supported by evidence. It's evidence-based opinion. So as you mentioned about your plane trip, Rich, everybody's entitled to an opinion. Yeah, it's going to crash, it's going to do this, but please support it by some evidence. So have an opinion, that's fine, but at least have a rational opinion that's based on evidence, right? Or else you're just talking like another ideologue, right? But that's a good thing, because the more people who are fearful of the housing market, the more it means opportunity for those that can rationalise the evidence,
cool.
And that just sidelines those that are missing out on opportunities.
Yeah. All right. Yes, we will give a copy of the webinar, and everyone who's on register will get a copy of the slide deck as well, and also the recording. Greg's asking, to what degree does the $3 trillion in superannuation funds, are they being now used to buy property? What proportion of property purchases will be made using super? Yeah, good question. What do you think, Andrew?
Well, there are limitations to how you can use super funds for property purchase, and that's deliberately done to control that sort of big lump of money in the marketplace. So it is constrained, and as anybody knows who's purchased property through super, there's a lot of hurdles to jump, a lot of bridges to cross before you can do that. So it's not as though it's something that you can manipulate the market with at any level, unless they change the rules, which is you can't have a material benefit from superannuation. But, maybe that's part of how they could incentivize, because they're thinking of incentivizing private sector investors to provide that housing we so desperately need in our rental markets. Maybe it's access through the, through super funds. But certainly, I don't think that there's, we don't have the regulations or we don't have the structure for that to influence in any significant manner, in my opinion, housing market outcomes. But look, it's, we were using super, and there's still measures super can be used by first home buyers to get into the market. But again, we've had those for a while now, and it hasn't made a big difference. In fact, first home buyer numbers are falling like a stone at the moment, unfortunately, and we shouldn't be surprised at that, because high rents, high prices generally, and high house prices are just a shocker for
well, I think I know that some superannuation funds are looking to invest in BTR, build to rent, and I know some money will be going in there. And also individuals can buy property, investment property in their super fund. And we're seeing a lot with our clients, a lot of them, not just residential, but buying commercial properties through their superannuation fund, because we can typically get a yield of 6% net plus. So, and that's a really good opportunity. And also business owners buying properties using their super fund and then leasing back to themselves. That's another great strategy. But again, you need to get personalised advice, and we can recommend top accountants who can do that. Another question, Tony is asking, the lack of rental accommodation is a crisis, and talking about the family home being liable for capital gains tax if you rent part of it out. So are there any plans to insulate the family home from capital gains tax to help alleviate the crisis? Well, not that I'm aware of. I don't think there is. It's just one of those things that if you do rent out a portion of your home, it is going to be liable for capital gains tax. So again, I just say to Tony, or anyone out there, get advice around doing that before you do it. I do know a lot of buyers, though, are looking to buy homes to add a granny flat. And that's a great option to rent it out and to help cover the cost of the mortgage. So it's a really great idea to be able to get into an area that you may not be able to normally get into. And it's either got a granny flat or build a granny flat. And that's a good option. Moro's asking, do the houses category include townhouses, Andrew? I presume they do.
Yes, they do. Yeah. So it does include townhouses. You can sort of I do differentiate it on other models. But in a way, it's interesting you mentioned townhouses, because that's sort of the missing link in our planning kaleidoscope, is that we just have underbuilt medium density, particularly in Sydney, where there's a great need for that, particularly from downsizers, But once again, it's because of planning restrictions, and if there's one capital that's screaming for medium density, it's the Sydney market. But
we need that missing middle legislation to get through. That'll be a game changer. Jai is asking, is it too late to buy in Perth? Days on market is 8 days, consistently sold 15 to 20% above price guide. It sounds like it happened in Sydney and Melbourne during COVID. Look, it's never as necessarily too late to buy in an area. I guess the question is, why are you buying in a particular area, and don't have FOMO? I think, look, the Perth market is no doubt it's on an upward trajectory because it's also coming off a low base. What are your thoughts on that question, Andrew?
Yeah, absolutely. Perth's number one this year, but it is coming from a long-term depressed market following the end of the mining boom, the second mining boom, the end of the fly-in, fly-outs. But Perth's a very good prospect. It always was. It's just had some time to catch up. But it has a very strong economy. Its supply-demand environment is reasonably positive. There is upside there, but it's coming from a long way back, Rich, as you said, in a way. Now, that doesn't mean it'll catch up eventually. I think it's just sort of catching up marginally rather than going to leap forward and all of a sudden be back to the sort of median price comparisons with the other capitals that it had a decade or so ago. But I think there are good prospects for Perth. But look, really, I think there are good prospects across the board. It's just that it's got a bit more affordability in its favour because its prices are still significantly, lower compared to other capitals.
I think it's really important for Chai to make sure before you dive into any particular location is to think about your overall strategy. So, look at, how many properties do you have in a location? Are you looking for higher growth, higher yield, or a combination of both. And then the location will help you to achieve your overall goal. So don't just pick an area just because it's going up and try to jump in and catch the wave. It's important to look at the long-term prospect for your property that you're buying. Chai's also asking, has regional lost its charm given that many companies are slowly moving away from work from home? This is a good one, Andrew, because there was a survey done about the middle of this year. I forget who did it, but I saw it published in, I think it's Sydney Morning Herald or the Fin Review, and it was called Regional Regret. And they did a survey of 5,000 people that had moved away from the major capital cities and asked them, are you thinking of moving back in the next few years? And they found out of those 5,000 people that 25% had already moved back to the capital city. And another 35% or more were actually thinking of moving back. So I think, to answer that question, yes, a lot of the regions have lost their charm because the companies are insisting that they come back into the office 2, 3, or 4 days a week. But I think it's not so much that. I think the reason a lot of people move back is that they lost their sense of community and friendships and community. Yeah. And that's the main reason. They lost their family network. And it was like, oh, I want to move to this, wherever it was, but I don't know anyone. And they just felt really sad. So they've moved back. But other people have moved, made new community, and they love it. So there's always two sides to that.
Yeah, it was always overblown that, we're all going to live in the regional centre post-COVID, everybody's going there. I always said that was just, a bit of a thought bubble. And I think that survey is a bit of a thought bubble too, because the constraints were always going to be, yes, you're away from COVID. Yes, you have the sort of, country lifestyle, whatever. But the point to regional living is, this is why they're regional, is they don't have the level of infrastructure that you have in the big capitals. So you have to miss out on, medical, commercial, even job opportunities, compared to what you have in the capital city. But of course, as you alluded to, Rich, absolutely. The other point you have to sacrifice is friends and family, your social networks, your commitment. The other infrastructure is recreational infrastructure that obviously big cities are developed because they're big cities around those types of positives. So no surprise, but I think, as you said, it's just that, it was a move through the COVID period, which was predictable because of how severe lockdowns were. And of course, once that's behind us, touch wood, people readjust to making decisions, and they can do that perhaps in that work from home environment. But I don't think the insistence on working back in the office is a key driver of that change. I think it's just another choice of a better place to live.
Yeah, sure. And Jeff's just asking, Geelong, Newcastle, I don't consider them regionals. They're actually just secondary cities.
Yes.
That Newcastle is Australia's 7th largest city, and we're actually buying some great properties up there for our clients. Wonderful lifestyle appeal. So I wouldn't consider, I'd consider Orange or Dubbo or Maleny or, those sort of areas more regional.
Yeah, absolutely.
Good question here from an anonymous person about thoughts around additional taxes for short-term rentals, but not hotels. Do you believe it will make that these additional taxes will make more long-term rentals available?
Well, that's a theory, isn't it? And
what's the practice? What's going to happen?
Well, I don't know. The point is that different jurisdictions have different rules. And we've seen Melbourne now has a restriction of 180 days on the number that you can lease as an Airbnb landlord in a year. And that's designed to push back, push back perhaps some short-term landlords into the long-term market, to fix that problem. But again, does it mean that, landlords will just short-term landlords will just push up their rentals? Because rentals have gone through the roof on Airbnb, and there seems to be plenty of appetite to continue to pay those higher rentals, particularly when we're thinking about the surge in tourists that we've got now, particularly international tourists, that might be happy to pay that, so that you might be still getting a better return on your 180 days. But it's obviously problematic. And I'm not surprised, or I'm a little surprised so far there hasn't been any legal challenges to that. But we may see how that will pan out. But look, it's desperate times to try and find more houses more housing in Australia, particularly rental market housing.
Avinish is asking, will banks further tighten lending restrictions to reduce loan availability? Look, some of the banks have actually reduced their buffer rate. They used to have a 3% buffer rate, which would mean almost a 9.5% analysis rate. Some of the banks have reduced it to 2 or 1%. I don't think the banks are going to change their policy, or APRA is going to come in any harder to answer that question. What do you think, Andrew?
Oh, well, look, we've seen this market manipulation policies from banks, and it sort of is a cyclical policy position. They got their fingers burnt, APRA, with their macroprudential policies designed to reduce investor lending back in 2015-16. Maybe we can ask APRA, what do they say about the crisis in the rental market now, since we saw all the reduction in investors through that period. And they just say, well, we don't care because we're just about managing risk for banks, and we thought there were risks, whatever. But maybe we've got to ask, the big question is, should there be a protocol for the banks to follow to ensure the rights of the consumer? I'm not sure that's being followed now. It's interesting, Rich, that the average mortgage rate is now higher than it was back in 2012, and yet the official rate was higher in 2012. There's been a little bit of margin creeping going on there from the banks. So
they're getting their profits regardless.
Yes, that's right. So they've actually raised their interest rates at a higher rate than the Reserve Bank has raised its rates. So who's looking after the consumer, Mr. Government and
exactly,
Miss Government?
Exactly.
We need some action there, because you won't be relying on APRA, because they're just going to keep squeezing risk management, and that's their job. But we've only got 4 banks, remember, so they need to, and that's fine, I don't mind that, but we need to have somebody looking after the interests of the consumer, and that should be the government, surely. So
well, on that note, Andrew, can I just say a huge thank you today for your contribution?
My pleasure. Great to be here, Rich. Yes,
your insights, really appreciate it. Thank you, everybody, for watching today. And if you do have any questions, you can reach out to Andrew through his LinkedIn profile, or myself, richardpropertybuyer.com.au. Love to help you on your property journey. We wish you well. Hope you have a great, safe Christmas, and we look forward to seeing you again on our next event. Bye for now.
Thanks, Rich.
Thank you, Andrew.